Okay, we're 2.5 minutes into market open. It's July 23rd, Thursday. If we go to the one-day time frame, so we're trading NQ, we go to the one-day time frame, let's just look at prior market structure. We had this one-day gap right here. We had this low that didn't fill this gap, and then we had this bullish SMT divergence from this low on Friday, July 17th, that ended up sweeping this low and entering that one-day bullish gap. Now, that created an uptrend the past few days, and that uptrend isn't necessarily telling us that the market direction is bullish, because it's clearly bearish. This is just a retracement into a discount zone, especially after seeing a one-day bullish SMT divergence. It's just going to retrace, grab liquidity, and then continue in the dominant trend direction, which is bearish. We can kind of see that right here. But if you go to the 4-hour, you can actually get a clearer picture of it. Before I even get into the high time frame confluences and key levels and imbalances, let's just look at Fibonacci from this high to this low. Now, I don't trade Fibonacci, but it's just important to at least recognize it, especially after the retracement has already occurred. It can kind of substantiate the trade direction. So this high to this low, this was the 50% and 61.8% range that price perfectly retraced into, and now it's continuing in the dominant trend direction, which looks like we want to take out last week's low right here. Now, last week's low is also an intermediate low. Now, what that means is this low right here did not even go 50% of the way through this fair value gap. Now, this gap, this bullish fair value gap, is right here. It did not even go 50% of the way through. 50% would be where my dotted line is right here. So price can fill that bullish fair value gap on the one day even more and reject at this level, especially with this low being last week's high. So not only is it last week's high, it is resting within a one-day bullish gap that can generate some temporary bullish liquidity at the very least, if it's not long-term. So we know that price will react at this key level. And it's important to note that, because let's say we enter a short position up here, it might be smart to sell down here. But if we go to the 4-hour now, actually, you know what? Let me go to the one day again. This is the bigger move, right? If we it's easy to look at the 4-hour and think, okay, we're bearish. We're obviously bearish. But how do we know when the downtrend is likely to stop? Okay, so we did a Fibonacci for when the uptrend would stop right here. But now, if you go to the one day, even 1 week, macro, we are bullish. From this down, from this low right here to this high, we are bullish. And in relation to that structure, this is the 50%, this is the 61.8% range. So we could expect, right, it's not guaranteed, but we could expect price in this downtrend to possibly reach somewhere down here. And that just gives us the confidence that taking shorts is still okay to do even after taking out last week's high. Sure, we have some key levels, like we have this one-day bullish gap right here that we might want to sell at if we're in short positions, but it at least lets us know that selling pressure is still alive. Like, market still wants to retrace into this key level, find its equilibrium, and then continue in the dominant trend direction. So maybe looking something like that. It doesn't have to work like that. For all we know, price could just take out this low entirely, but if we take into account Fibonacci, that is an option, right? Now let's talk about entries for today. So we understand market structure now. We understand why price is where it is. Now, if we go to the 1 hour, we can get a clearer picture of where we are in relation to key levels. So again, we had that one-day gap right here that we successfully tested. And I don't see any 4-hour confluences on the buy side or the sell side. I don't see any 4-hour gaps that we could potentially work with. We had this one that we already wicked, and now we're breaking right through, right? We took out the low of this. So the only thing I could think is we might create a potential SMT divergence right here once 10 a.m. hits, or even before 10 a.m. hits, because ES has already taken out last week's low. So in relation to this low right here, this Friday, July 17th low, don't look at this SMT. This was for the impulse move here. In relation to this and this, ES has taken out this low. So ES looks like this, while NQ looks like this. That's a bullish SMT. If we stay like that by the time 10 a.m. finishes, then we have a 1 hour and 4 hour candle showing a bullish SMT divergence that is without a doubt going to create temporary bullish liquidity. And what that might do, here's my prediction, an SMT is going to be used for one of two purposes: to be a part of the bigger picture and drive price long term, and that is the direction that price will settle at. But if we know our daily bias is bullish and if we know our daily bias is bearish and we see a bullish SMT, we know that price is not going to settle bullish. It is going to be used for option 2, which is a temporary pullback into a discount zone for then price to continue in the dominant trend direction. So it might do something like entering into a discount zone here and then continuing bearish. And that is actually very important to see and makes a lot of sense, because when the market opens, when New York session opens, this will happen every time. And what this is AMD, accumulation, manipulation, and distribution. That will happen every day. Price will accumulate. It'll do that in pre-market or even up to the first hour of market open. Price will accumulate, and that'll just look like consolidation. And then price will manipulate that accumulation to the buy side or to the sell side. Once it manipulates, it will distribute in the same direction that it manipulated or in the opposite direction. And distribution is often based on what key level are we currently in and what our daily bias is. Distribution will typically happen in the same direction as our daily bias. So if my daily bias is bearish, I can expect distribution to also be bearish. And then manipulation could then be either, right? If I know my distribution should be bearish, because that is the only way I want to enter the trade, since it'd be a high likelihood of it carrying out, my manipulation could then also be bearish or bullish. So I predict that we'll want to have a bullish manipulation to the buy side. Here's why. If we go to the 1 hour, we have a 1 hour bearish fair value gap right here. So here's what I predict. Our 10 a.m. will create a bullish SMT divergence, even a 15-minute time frame. If this move happens very fast, it might just be a 15-minute SMT divergence. But in either case, we'll have an SMT that'll pull us into a discount zone, that discount zone being a 1 hour bearish SMT divergence. Price will want to enter that key level, create confirmation somewhere down here, and then continue in the dominant trend direction, eventually taking out last week's low. That is my prediction. And what the confirmation will look like once we enter this key level, and let's assume that we respect it, we reject this 1 hour bearish, we fill the inefficiency and we reject it. A confirmation would just look like us inverting a bullish fair value gap in the opposite direction. So if our main direction is bearish, we're looking for shorts, I want us to invert a bullish fair value gap on a low time frame. And a low time frame would be considered anywhere from a 30-second to a 5-minute bullish fair value gap. I'm looking for a candle body on the bearish to slam right through that bullish gap, proving it invalid, proving that sellers have taken control. That is my confirmation. The second I have a candle body, a clear candle body close, I will enter my trade. And that close needs to close below the second candle in that fair value gap sequence. In that 3-candle sequence, the close must happen below the second candle in that sequence, the open of that candle, right? So you'll see exactly what that looks like when the trade happens, if at all. But that is what I believe. And it is all substantiated by the bigger picture that market wants to continue bearish, that when we had this bullish SMT here, we retraced into a 50% range. In pre-market, 2 high volume bearish candles. Now we have a 15-minute, potentially 1 hour bullish SMT divergence, pulling us into a discount zone, very clear one, this 1 hour gap right here, very clear 1 hour bearish fair value gap, pulling us into that zone while clearing London lows again. So grabbing liquidity from London lows, filling this inefficiency, building selling pressure, then we enter our trade. But it's important to not enter directly at market open, because you would have been stopped out. We're having a slight uptrend into this zone. So until we do that, until price enters this key level, there's really nothing for us to do. So I'll resume once we do that. So now it's important to note the reason why we have this bearish fair value gap marked is because it's the highest time frame and it's the nearest to where to where price currently is if we want to take shorts, right? Don't miss out on the trade by being married to this inefficiency right here, because the 1 hour finishes in 10 minutes and that's going to create a new 1 hour gap. So I'm going to mark it. This 1 hour gap will take priority, especially if it shows confirmation. Of course, we're going to wait for confirmation regardless. This might not be the 1 hour bearish gap that we want to trade, but make note of it because this is going to be the nearest 1 hour bearish gap in 10 minutes if this candle does not fill this inefficiency right here. That is now your closest priority in looking for a confirmation. And if we start trading higher and we fill this, great, even better maybe. But don't be too focused on this that you don't look at the high time frame again and realize that 10 a.m. starts in 10 minutes and we'll have a new gap. And if you look at the 15 minute, a lot of times they won't even want to do it on the 1 hour, might do it on the 15 minute or the 30 minute. There's a 30 minute gap right here, but it's not a valid bearish fair value gap. And even then we've just barely entered. This is, I think, a consequent enroachment. That's what it is. We haven't filled the entire inefficiency of this bearish gap. And even then, it's not a valid bearish fair value gap because the candle body of the first or third candle are not closing within the wicks of the second candle. So I'm not too worried about what I'm seeing on the 30 minute or 15 minute with this slight rejection. I'm pretty confident that we'll continue higher and we will fill one of these two gaps. And once that happens, I'll resume. Okay, so we're an hour and 15 minutes into market open and we kind of consolidated right here for a bit. So if you look on the 1 minute time frame, you can see clear consolidation. I thought that we might have some buy side liquidity right here that we want to sweep to the upside, looking something like I thought this impulse move from this candle right here was it, that we'd come up here, grab liquidity at London lows and that 1 hour bearish fair value gap and then continue bearish. That's what I thought. But I think what's happening is I'm glad I didn't enter a trade because this is ridiculous, right? You do not want to be in a trade when price is moving like this. But on the 5 minute time frame at 9:40 a.m. we entered, sorry, on the 15 minute, 9:40 a.m. we entered this 15 minute bearish fair value gap. And I had two other ones marked. I had a 1 hour gap up here and a 1 hour gap up here, which rested around London lows, previous day low, and also this breaker block candle, which is just, it's just a point at which price would like to retrace into. Because, for example, a lot of people would see this candle, see us take out these lows and enter long positions, and they would still be in these long positions even when price is moving like this. And now they're at break even, and now they're in the negatives. So if they're in a buy, how do you close out a buy to go break even? You sell, right? So there is a lot of liquidity resting here for people to close out their positions. And then not only that, it's enough to drive price downward. That didn't happen. I think we had a very premium retracement, which is not ideal for entering a high probability trade. And that was us filling this 15 minute gap. And then this is when we filled the gap. And then I guess if we were to implement our strategy, we're looking to invert a low time frame fair value gap, such as this one. So I guess when we saw this candle body right here, this would have been a decent time to enter a 1-to-1 risk to reward trade. I'd probably put my stop loss up there and my take profit right here. And we'd still be in the trade. I mean, look, that mean I'd have to enter at 9:57 a.m. and close out an hour later, more than an hour later. That is way too long to be in a trade. That is way too long to be in a trade. That alone tells you that it is not high probability, especially when you see price action that looks like this. So if that was the move, then that's what it is. Price could hit that 1-to-1, but it is not an A+ setup. It is not a high probability trade for us. I would not recommend getting used to taking these kind of trades. Even if you see price hit your 1-to-1, don't get used to taking a trade like this, right? You want price to enter a high time frame, not a medium time frame like a 15 minute, especially with price consolidating like this, proving to you that this is a low liquidity zone, right? I'll resume if there's another opportunity. Otherwise, this is the trade. That's it. No trade today, preserving capital, and maybe tomorrow we'll have something.